Business acquisition is filled with accounting terms that you need to know. Here's a breakdown of the most important. First is the popular EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Now, this is just generally the cash flow generation of the business, and you're taking out factors that apply to the previous owner. So one thing is mistake is that people think that EBITDA is the amount of cash that a business earns, and that's not necessarily true. It's just there are things that need to be substituted. So you subtract out the interest that the seller is paying, and you're going to have to insert the interest that you're going to need to pay. You add back the taxes that the seller is paying, and then you're going to need to subtract the taxes that you're paying. And same with depreciation and amortization. That's actually replaced with CapEx. So typically when you buy equipment, you depreciate it on your tax returns. The purchase of the equipment would be called a capital expenditure, or CapEx. So that's money that you have to spend to keep the company up and running. So the CapEx can really be divided into two categories. You have just maintenance CapEx, which is really what you just need to spend to keep the business alive. So if you have a trucking business, you need to buy a new truck every year just to keep your fleet up and going. That would be maintenance CapEx. Growth CapEx would be money that you spend to grow the business. So if you need to buy one truck per year just to stay where you are, if you're buying 2 trucks per year, then you're investing in growth in the business. So figure out how much cash a business actually generates on its own. You want to take the EBITDA, put your interest expense in, put your taxes in, and then put your CapEx level in to figure out your cash flow. And speaking of cash flow, that's what most listing websites use to show what's basically the EBITDA of the business plus the owner's salary. So it's all the benefits going to the owner. That would also include any fringe benefits. So if they have a vehicle that's paid for by the company, or if their vacations are paid for by the company, that would all get added into cash flow, or what's also called SDE, which is seller's discretionary earnings. So that's just money that's going to the seller. That's money that would be going to you as the buyer to make your loan payments, to spend on CapEx, to fund your lifestyle, to pay your mortgage, to make your car payments, things like that. Goodwill is generally the value of the business above the value of the tangible assets. So if you have a company with $1 million of trucks, and that's all the assets they have, and you buy it for $3 million, you've acquired $2 million of goodwill. Now that comes into play in financing. There are some lenders that have limitations on how much goodwill they're going to fund, or they might require a higher debt service ratio for certain levels of goodwill. There are lenders out there that don't take that into account. We know who they are, so if you need one, let us know. And one of our favorite is the valuation multiple. Typically, we're just looking at this as a multiple of cash flow. So the way you look at the multiple, so if you have a business that's asking $4 million and they generate $1 million of cash flow, they are selling at 4 times cash flow. Now, one way to make that a little easier to think about is you can take the inverse of that, which means that particular 4x multiple is actually a 25% yield. For some people, it's a lot easier to think in yield. It's a little easier to compare it to other things. So it puts it on par with what you can earn in a bank account, or the cap rate, which is the rate you'd earn on a real estate investment. You can compare it to your debt. So if you're buying something with a 25% yield and you're financing it with 11%, it's clear that there's obviously a spread there that you're going to be able to profit off of. So generally, the higher the multiple, the lower the cash flow yield you're going to have, the less money you're going to have after making your debt payments. So let's say if instead of 4 times cash flow, you paid 8 times cash flow. So now instead of 25%, your yield is now 12.8%. Now you don't have a lot of spread between that 12.8 and the 11.25% interest rate where the SBA loan sits today, and your cash flow is actually going to be negative because SBA loans are 10-year loans, so you're paying down principal. No bank is going to give you a loan to do that deal at 8 times. All right, now here's our most important and least understood: working capital. So working capital is the money that you need to run the business day to day. If you don't have enough working capital, you are out of business. You are shut down. So it's really the most important number to calculate during a business acquisition to make sure that you have enough working capital to run the business. Now, good thing is when you do an SBA loan, they'll lend you money, typically up to $500,000 of working capital on top of the loan proceeds. You can also get it from the seller in the form of seller financing, or you can have the seller leave it in the business, just negotiate it in the deal. So there's lots of ways to get working capital, but you need to calculate it right. We have detailed videos on how to calculate your working capital needs. Just go search Owner Actions Working Capital. Lastly, the biggest factor in whether a bank is going to approve your loan or not is the debt service coverage ratio. So that's essentially just a measure of the business's ability to make the loan payments. So Most banks are going to require 1.25 as a debt service coverage ratio, and just think of that as it needs to cover 125% of the loan payment. There's a lot that goes into this calculation. We have some really detailed videos on this as well. Just search for Owner Actions debt service coverage ratio. Do we miss any terms that you want to know about? If so, leave it in the comments. We always try to answer all the questions there.